Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. I hope you had a fantastic festive season and I wish you a very happy, healthy and successful new year. Welcome to the first Money Talk of 2024. I'll be here every business day this year, bringing you the latest business and finance news from across Asia. You can find us on Substack at peterlewismoneytalk.substack.com. We're also on Apple Podcasts, Google Podcasts and Spotify. And you can also contact the show on Facebook. Peter Lewis Money Talk is the page, and on X at Money Talk R3. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Here are the business and finance headlines for Wednesday, the 3rd of January, 2024. China's economy showed fresh signs of weakness in the final month of last year. An official survey by the National Bureau of Statistics released Sunday showed factory activities slid deeper into contraction in December. The manufacturing PMI in China fell to 49 from 49.4 in the prior month, missing economists' estimates of 49.5. However, a Caixin survey released yesterday showed that manufacturing activity in China among smaller private businesses expanded in December. President Xi Jinping used his annual New Year address to the nation to issue a warning to Taiwan's voters just days ahead of the island's presidential election on January the 13th. In a televised speech on Sunday evening, President Xi said the reunification of Taiwan and China was a historical inevitability. Taiwan President Tsai Ing-wen, who delivered her final New Year address on Monday in Taipei, said cross-strait relations should be decided by democracy and the will of the Taiwanese people. Chinese group BYD has unseated Tesla as the world's top-selling electric vehicle manufacturer after reporting bumper fourth-quarter sales. A Shenzhen-based company said on Monday that it sold a record 526,000 of its battery-only vehicles in the quarter, helped by a more than 70% surge in December sales. On Tuesday, Tesla reported 485,000 deliveries for the fourth quarter, bringing the 2023 total to 1.8 million. Global bond and stock markets added almost $20 trillion in capitalization during 2023, and all of that gain came in the last 2 months of the year. The gains were dominated by global stocks, which added $13.3 trillion, while global bonds rose by $6.1 trillion. The MSCI World Index surged by 16% since late October and was up 22% last year, its best performance for 4 years. But in contrast to the strong performance seen in other global markets, Hong Kong's Hang Seng Index sank for an unprecedented 4th consecutive year and the 5th year out of the past 6. The City Benchmark Index fell 13.8% in 2023. On today's programme, I'm joined by Andrew Sullivan, founder of Asian Market Sense, and Nick Marro, lead for global trade at the Economist Intelligence Unit. With a view from Japan is Tokyo-based journalist and author William Pesek.
Peter Lewis's Money Talk.
US stocks dropped on Tuesday amid rising bond yields as investors scaled back bets on rapid interest rate cuts from the Federal Reserve. The S&P 500 index lost 0.6% to settle at 4,743. The Dow added 26 points, or 0.1%, to close at 37,715, and the Nasdaq Composite was pulled lower by poor performance in technology stocks. The tech-heavy index tumbled 1.6% to 14,766. Shares of Apple were down 3.6% after Barclays downgraded the member of the Magnificent Seven basket to an underweight rating. US Treasury yields kicked off 2024 by jumping higher. The 10-year yield rose 8 basis points to a 3-week high of 3.94%. On Tuesday, the dollar jumped higher to start 2024. The US dollar index climbed 0.9% to 102.25. That's its biggest daily gain since March 2023. Gold was 0.2% lower at $2,058 an ounce. Oil prices initially jumped over 2% higher after Iran dispatched a warship to the Red Sea in response to the US Navy's sinking of 3 Houthi boats over the weekend. But the contract reversed gains later in the session amid a backdrop of record US production and faltering demand in China. Brent crude oil settled 1.3% lower at $76.09 a barrel. Bitcoin surged to its highest level since April 2022 amid speculation that the US Securities and Exchange Commission will soon grant regulatory approval for exchange-traded funds tied to the cryptocurrency's spot price. The world's largest cryptocurrency rose to $45,900 at one stage yesterday, bringing its total gains since the beginning of October to 70%, and it's currently trading at $44,850. Chinese stocks fell on the first day of trading in 2024 after official data showed China's manufacturing PMI contracted further in December. The Hang Seng Index closed 259 points lower, or 1.5%, at 16,789. The tech index slid 1.3%. On the mainland, as trading resumed after the New Year holiday, the Shanghai Composite fell 0.4% to 2,962, and the CSI 300 tumbled 1.3%. Looks like Hong Kong stocks are going to decline about 1.2% at the open. Futures markets pointing to a decline of about 200 points for the Hang Seng, setting it off at about 16,590 when trading gets going this morning. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On the first Money Talk of 2024, let's welcome our guests. We have with us Andrew Sullivan, founder of Asian Market Sense. Happy New Year, Andrew.
Happy New Year to you, Peter.
And also with us is Nick Marro, who's lead for global trade at the Economist Intelligence Unit. Welcome and Happy New Year to you as well, Nick.
Happy New Year, Peter. Thank you.
Now, as you heard there at the beginning, global bond and stock markets, they added almost $20 trillion, US dollars, that is, in capitalization during 2023. And nearly all of that gain came in the last 2 months of the year. The gains were dominated by global stocks, which added $13.3 trillion. Global bonds rose by $6.1 trillion. And global stock markets, they recorded their strongest year since 2019 as investors bet that major central banks have finished raising interest rates and are going to cut them rapidly next year. The MSCI World Index it was up 22% last year. That's its best performance for 4 years. That was largely fueled by the Wall Street S&P 500 Index. That surged 14% since October and 24% over the year, ending the last trading day of 2023 just 0.6% shy of its all-time record. And the gains have been driven by a dramatic shift in interest rate expectations. Andrew, let me ask you, if we go back to the beginning of last year, there were 3 calls that pretty well all analysts were making. That was sell US stocks, buy treasuries, buy Chinese stocks. And in fact, in the end, it turned out it would have been better off doing the reverse of all those 3. How did the consensus get it so wrong last year? What did they miss?
Well, I don't think they were wrong on the Chinese play, to be honest, because we've just seen Chinese pivot as far as their zero COVID policy was concerned. I think the problem really came is the fact that the recovery in China didn't pan out as people were expecting, largely because of the overhang of the property crisis that has continued to be unresolved in China. But I think with regard to the other 2, I mean, again, people are still concerned about the strength of the US economy. And certainly this time last year, the strength of the US dollar was a concern, and it was a very, very crowded trade. And we did see, some people come out of that trade through the year. But the US economy, did stay much stronger than people were expecting. Fed did do a pivot themselves as they realized that inflation wasn't transitory. If you remember, they were saying last Christmas that they just thought it was a transitory thing. They realized it wasn't and moved very quickly to raise rates, which again gave a good reason to be in the US dollar and the US economy.
Nick, do you think maybe they were just a year out, that maybe at the beginning of this year we are going to see the US recession and US stocks fall, and maybe now is the right time to start buying Chinese stocks after the terrible year we had last year?
Yeah, I feel like that discussion is kind of similar to what we've been having the last couple of years. This idea that we know shocks are coming and shocks eventually do materialize, but the timing tends to be a little bit off. People maybe are a bit more anxious kind of initially, and it takes a while for that anxiety to feed actually into the data or into the market. I think we are getting some signs in U.S. economic data around the resilience of consumer spending, maybe tapering off a little bit. The idea that the effects of, the tightening by the Fed are now finally feeding into the economy, and that 6-month time lag is starting to really bite. And so, right now, I think if we look into the very near term, and I'm talking about the next couple of quarters, we could see a period of a bit more sustained stress than I think people, people were predicting to happen a couple of quarters ago and are now finally materializing. So the near-term outlook does look a little bit kind of risky, and I think that's one of the reasons why the market is pricing in these expectations for, sustained easing by not just the Fed but other major central banks globally. And so, the near-term outlook, I think it's still relatively kind of concerning. But one thing that has continued to surprise us, as you've pointed out, Peter, is the fact that the U.S. economy and particularly U.S. consumers have proven more resilient than a lot of us have expected. And so, risks to the upside are still very much there.
Andrew, the big driver, of course, behind last year was those magnificent seven stocks, and also particularly anything related to AI. But is this the year now where these companies that have been riding the AI wave, they've got to prove themselves this year and show that actually there is money to be made from it? Andrew?
I think monetization of AI is going to be very, very important. And I a lot of these firms aren't yet. Their data isn't in a format that can be easily used by AI yet. So there's a lot of cleaning up of the data that's got to take place. And people have really got to try and take it on board. People aren't sure whether they should be going in-house with this or using third-party contractors. I think the reality is it's still going to take a lot of time for people to play with AI and understand what it means. And in the meantime, I think a lot of investors are looking elsewhere in the supply chain, from NVIDIA to other stocks that are going to benefit, whether that's you're going all the way down to the data centers, to the memory side, or just to the wiring side, transformers, electricity demand, cooling. There's a whole range of different avenues that are going to look to be played out here. And I think rather like the internet, there's not going to be one killer app for AI, but there are going to be a lot of different usages of it, and it's a matter of finding ones that are good investments.
Do you think, Nick, AI, is that going to be a big theme once again this year? And are we going to carry on seeing these big outperformers in some of these big tech stocks?
Yeah, I think so. Based on just everything that Andrew said, there's so much happening in AI. And there's just so much avenues for a lot of really exciting things to happen. I think in many ways, even if there isn't going to be, a killer app, it is going to revolutionize how we do things, how we think about things. I guess the one caveat that we're looking at and that we're a little bit worried about is the geopolitical angle here. There's so much happening with AI, and everyone wants to get involved, but this is happening at a time when AI is also becoming kind of the next battleground, or one of the next battlegrounds of geopolitical tensions, particularly between China, not just China and the U.S., but China and the West more generally. This, feeds into what's happening with export controls and restrictions over, say, semiconductors. We just saw news earlier, I think overnight or earlier this week, around how the U.S. has pressed ASML to restrict some of their advanced equipment shipments to China a bit earlier than their earlier deadline had stipulated. And so, one of the big constraints here is how is policy and how are these tensions, how are they going to constrain a lot of the excitement and activity that could manifest under AI? And so that's one of the things that I think investors will need to be aware of in terms of where they position themselves as this sector develops and where these opportunities kind of emerge. It doesn't mean that the AI is less attractive or there aren't any opportunities there, but there are still risks that need to we need to be aware of.
On that theme of geopolitical tensions and trade tensions, I think if there was one word for 2023 that stood out, it was de-risking, wasn't it? Which sort of came up as a sort of an alternative to decoupling. The G7 decided they didn't like the word decoupling, so they tagged on to de-risking. Is that going to be a theme, do you think, this year as well?
I think so. And I think, when you look at the discussion between decoupling and de-risking, at the end of the day, it's just kind of mincing words a bit. You look at what's happening with the Europeans, for example, and just in the last couple of months alone, the kind of, array of European trade measures that have been, unveiled against China or are being under discussion right now in regards to China, it really has been quite aggressive. It's included things like electric vehicles and chips, but we're seeing discussions around, medical devices, wind turbines, steel products. The gravity in terms of trade tensions just in the last couple of months alone seems to have shifted away from US-China and more towards EU-China. And so whatever we want to call it, whether it's decoupling or de-risking, this idea of geopolitics infiltrating the discussion around trade and kind of economic affairs, that's going to continue. And regardless of what happens with China's rebound or kind of Europe's slowdown or what's happening with interest rates, geopolitics is going to continue to be an increasingly important theme, I think, as we look into 2024 and likely the years beyond. There just seems to be so much happening and quite a number of events just immediately on the horizon.
Andrew, where does de-risking go from here? It's sort of spreading out, isn't it, to a whole range of companies and sectors and countries as people try to diversify their supply chains. Where do you see this going?
Well, I think we've already seen it, that they will try and friendshore. So places like Mexico have benefited, certainly. But I also think, we've seen people look at India. I think within Asia, we've already seen a lot of processes move out of China into Vietnam and into Indonesia and Malaysia. I think that trend will continue. You may see, some movement into Cambodia as well. But I think for a lot of people, India is the big one. We're also seeing, interestingly, a number of the Japanese firms taking their supply chains out of China and onshoring them again. So I think that trend is going to continue. And I think going back to the earlier point, that's kind of what's making China less investable for a lot of people. Because of the policy changes that happened so quickly there, people are very wary about putting their manufacturing there again. China locked itself down, and that's a concern. You can't have that. You can't have a just-in-time supply chain anymore if the country that your supply chain routes through is likely just to isolate itself. And I think it'll take investors a long time to rebuild confidence in the Chinese administration for acting in the best interests of commerce rather than in the best interests of the party.
Is it, Nick, is de-risking working? I mean, we know that supply chains are certainly getting longer, but are they necessarily diversifying? Are you seeing that happening as countries like the US hope?
Well, probably not going to like this answer because it's a very economist answer, but yes and no. Yes, in the sense to what Andrew was saying, in the sense that there is a lot of genuine interest in places like India or Southeast Asia or Latin America, even Eastern Europe to some countries, in terms of supply chain relocation and manufacturing investment that is materializing as part of all of that. So we are seeing activity happen on the ground. And as part of that, we are indeed seeing some processes, some manufacturing processes that China had long dominated move out to other markets. And so we are indeed seeing elements of this diversification. At the same time, China is an incredibly important part, plays an incredibly important part in the global supply chain. When we've seen supply chains reroute into Vietnam or Malaysia, many of the supply chains are still very much dependent on raw materials or intermediate components that are being sourced from China. And if you look at the trade data, Chinese exports to ASEAN are increasing as exports to the U.S. are kind of falling off. But then ASEAN exports to the U.S. are increasing. And so really it's just, rather than the product going directly from China to the U.S., it's going from China to Vietnam and then to the U.S. That's not true for every product, every industry, but that does seem to be kind of the overall guiding narrative here. This idea that indeed supply chains are lengthening, they are diversifying, but they're not cutting China out of the equation. And really, it depends on who you're talking to in terms of what the goals are here. If you're a company that just wants to diversify and kind of make sure that your just-in-time supply chain operations are going to be insulated from shock, this might be sufficient. If you're a policymaker in DC who wants to get Chinese products completely out of your, supply chain basket or your economy, then this probably is not going to be the outcome that you're hoping for.
I mean, Andrew, I suppose the classic example of this is Taiwan, isn't it? 92% of all high-end semiconductors until recently were made in Taiwan. But now we're seeing countries like the US, Europe, building their own chip industries, and China as well, of course, and trying to create more sort of independence in areas such as rare earth minerals, electric vehicles, pharmaceuticals, and so on. So presumably Taiwan is one of those countries that, well, is not a beneficiary really of this, is it?
Well, I think Taiwan is slightly different because, I mean, Taiwan, yes, they are moving a lot of those processes overseas, but they're keeping the most advanced tech at home. That's still going to be the Taiwanese umbrella. That's still a part of their defense policy, I think. And, that kind of makes sense as well, because even though TSMC is looking at building plants in America, in Japan, and in Europe, the reality is that there really aren't the skilled technicians that these processes need currently available in those countries. Because we allowed all of this technology to become very precise and we outsourced a lot of it, other countries have lost that technical know-how to build it up. And I think to an extent that does rather justify the US's policy of trying to curtail China's growth in the chip sector, is the fact that actually, without being a leader in this field, finding the technicians that you need just to operate the plants, let alone to design and build the plants, is very, very difficult.
I mean, Nick, you mentioned ASML earlier. I mean, ASML is kind of under pressure from the United States to cut off sales of advanced equipment to China. Are we going to see more of that sort of pressure this year?
I think so. I mean, I think it was in September in 2023 when we received kind of news that China had achieved significant advances in very advanced chip manufacturing. I think they had reached maybe the 5 nanometer mark, 7 nanometer mark. Anyway, one of the nanometer marks which signaled significant advances in innovation. That was a wake-up call to not just industry, but also policymakers, because this was one of the main goals that, particularly the U.S. export controls were designed to prevent from happening. And upon kind of investigation of what happened here, there seems to be, those breakthroughs were achieved via a combination of potentially technology leakages, but also the utilization of equipment that had not been subject to this export controls, but which still allowed China to achieve those advances. I think right now the conversation in D.C. and maybe other capitals in the world are around, do these export controls need to be tighter? Because they're coming at the cost of preventing their companies from, expanding their commercial opportunities in the Chinese market. And so if you're going to do that, you better ensure that these controls are tight, and that they're not going to, embolden your Chinese competitors to, continue to innovate and eventually become, rivals to your homegrown companies. Essentially, you don't want to, you don't want to shoot yourself in the foot as a result of these policies. I think this discussion is going to continue into 2024. This idea that there needs to be a stronger approach to China's tech sector, and the fact that these technology breakthroughs present a pretty significant threat to national security. And that's going to be something that's not just going to be a conversation in the U.S. It's probably going to be a conversation in Europe, Japan, Taiwan, South Korea as well.
Okay, Andrew, let me switch to Hong Kong and China. I'm wondering, what are the chances of a surprise from China this year, and that maybe at the third plenum we get much stronger signals of China supporting the economy, also maybe supporting the property developers, the property sector? Do you think there's a chance we could see that?
Personally, I don't, to be honest with you. I think they are too concerned about the potential for inflation. And reality is that, this housing crisis started because President Xi wanted to get money out of property and into advanced technology. In China, a lot of people use property as a store of value like the Indians use gold. That doesn't help China, finance, as Nick was just saying, finance its move up the technical ladder to start doing these new processes. It needs, the amount of money that TSMC spends on R&D, puts some, country's GDP into shame, really. And that's the nature of the amount of finance they need to find. And the reality is a lot of that money in China is just lying idle in empty properties. And this is what, Xi had the right idea about trying to move the money out. He just tried, I think, to do it too quickly, and has created another, unforeseen, casualty as a result of that. The idea was a good one, but the implementation of it was badly done, and now they Now they have two problems. One is that they're behind on technology, and secondly, that they have a crisis, and actually the value of that money tied up in property is going down.
Well, what do you think, Nick? Are you optimistic at all that we may see more policy support out of the mainland this year, which we were hoping for last year, but didn't really materialise?
Cautiously. So, I mean, we'll probably see more policy support, just given the fact that if we see a 5% growth target in 2024, for example, that is going to necessitate more government spending. And so inevitably there is going to have to be, a enhancement in government support measures to make up for growth that's not coming out of other parts of the economy. So there is going to be some support measures, but the reason why I'm kind of equivocating here is the fact that, the expectations for really large scale stimulus and effective stimulus, maybe I should say that's probably going to be challenging, just because, the property sector is in such a mess right now, and it's such a distraction for policymakers that it really is complicating maybe the effective deployment of kind of fiscal resources to ensure that money is being channeled into actually productive parts of the economy. That's one thing. The second thing is, for everything that we've kind of talked about and what Andrew mentioned as well, when we look at 2023, one of the main themes for China was policy uncertainty, and the fact that you had all of these policies that were coming out which were either disappointing market expectations or actually further undermining not just foreign investor confidence but private investor confidence as well. I think one thing that we're seeing with the leadership is that it has not signaled any kind of intent to move away from that kind of policy design, this idea that policy making is still going to be relatively erratic. There's still going to be kind of negative surprises that affect investor confidence. Just, the last week we saw, draft regulations in the video game industry, which were then kind of rescinded because of the negative effects it had on the market. I think that's going to be something that we see in 2024, this idea that policymaking is still going to be really volatile. And as a result of that volatility, investor confidence is still going to be relatively tepid.
So, Andrew, if we're going to have...
Also, Nick, I was just going to say, just following up from what Nick said there, The Economist ran a very good article recently. I mean, the clamp down on data may also mean that the top guys in policy making in China aren't really getting a true picture of what's happening on the ground. And I think that's another concern for investors. This clamp down and security on information is actually stifling the ability of Xi, now that he's got a much tighter knit of close allies, really running the country, of getting a proper picture of the state of the economy.
So if we're going to have this volatile policy making continuing this year, what does that mean for the outlook for Hong Kong equities? We saw them the worst performer in the world last year, the Hang Seng down 14% almost. We're down 4 consecutive years, 5 years out of the past 6. Any reasons for us to be optimistic that maybe this year we will finally see the turnaround?
I'm not sure about a turnaround, but I think you'll still see selective opportunities. Certainly, Hong Kong property is very closely geared to Fed interest rates. And if we do see an easing in interest rates there, you could see the property developers doing slightly better. But the reality is, Hong Kong property is very expensive. And if Hong Kong is no longer going to be the big international finance center that it has been in the past and the gateway into China, which seems to be being curtailed by the national security law worries and things like that, then the outlook for Hong Kong is actually quite depressing. But interest rates and the play on Hong Kong property would be one. And there are still some good companies listed. You've got Tektronix making electronic goods, which if the people aren't moving in the US, they're going to do more DIY. That has the opportunity. We see some of the Samsonite, as people come back to go traveling, they're likely to do well. So I think there are still good companies there, but I think you have to be a lot more selective and pick companies rather than saying I'm going to invest in the HSI.
We do seem to have the national team intervening. Certainly last week, they appeared to be doing so, didn't they? Buying ETFs quite aggressively in the market. Is that maybe the way forward? I mean, some of the big popular stocks among foreign investors like Alibaba, Tencent have really been the poster boys of everything that's gone wrong in Hong Kong and China over the past year or so. Is maybe the story to try and avoid some of those and look out at some more broader, at the broader picture, some other less loved stocks in Hong Kong and China?
I think there's an element to that, but I think also the problem really comes that a lot of people will, just as for the last 15 years we've been trading Asia ex-Japan, we'll now start trading Asia ex-China. And interestingly, people will look at stocks in Japan and in Korea that allow you to pay the consumer market in China rather than having to go directly into China. And that will be to the detriment, I think, of Hong Kong in the longer run.
And Nick, finally, a quick thought on Japan. 2023's best performing market in Asia recorded a 28% gain, the Nikkei 225, back to sort of 33-year highs. What's the outlook for Japan?
Yeah, well, one thing that we're looking at really closely is what's happening with monetary policy and whether the BOJ is, or to what extent the BOJ is going to, tweak its control, yield curve control. We're still expecting the BOJ to normalize its policy settings gradually in the next 2 years. We're expecting relatively steady but moderate growth in real GDP, kind of mild inflation. But this is going to be something which weighs very heavily on the Japanese leadership. In addition to what's happening in the economic picture, we are seeing some electoral dynamics come to the fold in Japan in 2024. And I think that's going to have kind of a trickle-down effect for policy as well. So I guess for all of us looking at Japan in 2024, it'll be a mixture of what's happening with monetary policy, kind of, not necessarily all that amazing growth, but kind of stable growth, and then the political dynamics and how that's going to change all of that.
Andrew, quick thought from you on Japan for 2024?
Yeah, I agree with what Nick's just said. I think that's a very good summary of it. I think it's expected to change policy. They've indicated that they want to change policy. And I think the other thing people are seeing in Japan is, change at the corporate level and in the way the companies are managed, which makes them much more attractive, open to more M&A. All the things that we haven't really seen in Hong Kong for the last 2 or 3 years, which is going to highlight that. And of course, the other one that people will look at is India. Those two markets, I think, are probably going to be top of people's radar screens.
Okay, well, thank you both very much for your thoughts this morning. Great to hear from you, and have a great year ahead. That's Andrew Sullivan, who is founder of Asian Market Sense. Nick Marro, lead for global trade at the Economist Intelligence Unit. I'm joined now by Tokyo-based journalist and author William Pesek. Morning, William, and Happy New Year to you.
Good morning and Happy New Year.
Well, Japan 2023, it was the star market in Asia, the best performing regional market, up 28% year to date, back to 33-year highs. I mean, if you could sum up what was behind that, what were the main drivers behind this outstanding performance for Japan?
Well, I think Japan had a bit of a safe haven halo in 2023. I think when the investors looked at the world at large, they looked at the U.S., which had the highest bond yields in 17 years, the Federal Reserve raising interest rates, Moody's Investors Service warning about a downgrade, China slowing, Europe kind of walking in place. You put all these pieces together, and Japan looked like a relatively quiet market with a lot of cash-rich, some would argue undervalued companies to consider. Warren Buffett, of course, in recent years, has shined a bit of a spotlight in Japan's direction. And you put together the geopolitical chaos of 2023, and Japan seemed like a quieter, safer place to be. And I think the stock market, in many ways, reflected that.
So is it going to be a quiet, safe place to be in 2024 as well? Can this continue?
Well, considering the first couple of days of this year, I'm kind of reluctant to say that.
Yeah, it's been a scary start.
Who knows? I mean, it has. I mean, one of the problems Japan has is that Japan arguably ended 2023 in something of a recession, right? You saw the economy contract 2.9% in the July to September period from the previous quarter. And in some ways, you can argue that Japan might be in something of a modest recession at this point. But one of the problems you see as 2024 begins is that the external sector, the external scene is not great, given the fact that China is slowing. The U.S., who knows? You have a lot of geopolitical issues to worry about. And the other thing, too, is here in Japan, Prime Minister Kishida's approval ratings are about 17%. And so for investors who'd been hoping that he would get around to enacting big economic reforms, The question is, does he have the political capital, A, to do that? And B, will Prime Minister Kishida be shown the door pretty soon? Because, in Japan, when cabinet's approval rating falls below 30%, that's kind of the danger zone. You have Prime Minister Kishida now at 17%. So it's an open question.
So is that going to impact the markets? Is there going to be a focus on politics, or are investors just going to plow ahead in it regardless?
Well, it could be. I think it kind of casts a lot of doubt on the Bank of Japan, right? I think many investors assumed that 2023 would be the year when the Bank of Japan finally began to exit quantitative easing. That didn't happen. And if you're looking at, if you're looking at the year ahead, there's nothing in what Governor Ueda is saying at the BOJ to give us any confidence that the BOJ will be making very big decisions over the next few months. And that's a bit of a wild card. I think, one of the big issues for Japan, of course, is China, the trajectory of Asia's biggest economy. And until Japan has a better sense of where China's heading in the next 6 months, it's hard to get a real grain on the economy here.
So is the Bank of Japan going to see the wage inflation that it's hoping for, and everything seems to be depending upon that arriving for us to start moving away from this negative interest rate policy?
It's a good point, because a lot of the inflation Japan has experienced to date has been imported from the external sector. You've had oil prices, you've had food prices elevated over the last couple of years. But will Japan begin to generate some domestic inflation, which is kind of what it's wanted over time? I think in many ways the BOJ is trying to create this virtuous cycle where companies have record profits, they share it with workers, and you have this virtuous cycle of increased consumption. Will that happen in the year ahead? Hopefully it will. I think it will depend a lot on the external sector and whether or not Japan is importing too much inflation. But certainly the BOJ does have a scope to begin stepping away from QE. I think it has political capital to begin stepping away from QE. And the question is, does Governor Ueda, does he have the courage to do so? I hope he does, but we'll see. And
the other successful trade last year, of course, as well as buying Japanese equities, was shorting Japanese government bonds, which up until recently was a pretty perilous strategy, wasn't it? It's a lot of people went broke pretty quickly trying to do that, but last year that strategy worked.
Exactly. It's been the ultimate widowmaker trade in recent years. I think one of the biggest questions for the world at this point is the so-called yen carry trade, right? When, for the last 20 years or so, borrowing cheaply in yen and redistributing those proceeds to higher yielding markets everywhere has been a very reliable trade. And if the yen is going to experience volatility in the months ahead, what does it mean for the yen carry trade? And that's another thing the BOJ has to worry about. If the BOJ does do anything rash and global markets do begin to experience some turbulence, the last thing Japan wants to be is blamed for the next, I don't want to say global financial crisis, but the next bit of financial instability. And so the Bank of Japan really does have a lot to consider as it looks at the year ahead.
And what about companies? They're posting better results, aren't they? Obviously that's partly been due to the weaker yen, but is this helping making them more competitive and adding more fuel to the stock market fire?
Well, it's a very difficult moment here in Japan because, again, we've had 24 years of zero interest rates, 22 years of quantitative easing. A lot of companies, a lot of banks in Japan have taken it for granted that we would be experiencing free money forever. Now we're looking at the specter of the BOJ tapering and stepping away from that. And the question is, can corporate Japan profit and thrive without the yen depreciating, without the BOJ pumping lots of money into the economy? And it is a unique challenge for corporate chieftains, many of whom have not operated in an environment where yields and interest rates were rising. So the question really is corporate Japan as ready for the BOJ to step away from QE as we hope? And that's an open question.
And what about foreign investors? They've been pretty keen on Japan, haven't they? And they've had some pretty big cheerleaders last year, like Warren Buffett, who's been a big fan of some Japanese companies. Are we going to see that, do you think, continue this year, particularly with the weaker yen? And also, presumably, because China has been in the doldrums, companies diversifying away from China. That's also benefited Japan.
Right. I mean, for the foreseeable future, it should continue. I mean, when you look at some major investment banks like, say, Morgan Stanley, they're looking at Japan as a star market in 2024. And, Japan, despite the fact that it might have ended 2023 and something of a technical recession, there is a sense that wages are rising in the year ahead. There is a sense that Japan is a stable, more hospitable place than it's been in a long time for foreign investors. I think the question, though, is will investors begin to look at the road below and feel that the government is keeping pace with this optimism in terms of economic reforms? And again, with Prime Minister Kishida having approval ratings around 17%, how much political capital does he have to take steps to raise Japan's economic game in the way that investors have hoped that he would? And I think it is this interesting tension between, where Japan is at the moment and where investors hope it will be in, say, 5 years.
And how much focus should we put on Japan-China relations next year? I mean, they haven't been great, have they, in this past year? Is this something we need to watch closely in 2024?
I mean, I think so, yes. I mean, I think Prime Minister Kishida has done, he's taken significant steps, I'd argue, in trying to improve relations with China and with South Korea. I think the biggest wild card for the year ahead is the U.S. election, right? I mean, I think the one thing that Republicans and Democrats in Washington agree on is blaming China and blaming Asia in general for America's economic problems. And will Japan get dragged into that in some ways because of the weak yen? Donald Trump, of course, is running for re-election, or running for election again, should I say. And he has never been shy about talking about exchange rates. And, when you look at the yen being down so significantly over the last few years, certainly over the last 12 months, will Japan find itself in harm's way as Democrats and Republicans do battle, in terms of the upcoming election? So I think that's something Prime Minister Kishida has been worried about, and we'll see how that plays out.
Is Japan ready for a Donald Trump presidency?
I don't think anyone's ready for a Donald Trump presidency, least of all Japan. I do think, I think it is interesting the way in which you do see that the machinations here in Tokyo. Prime Minister Kishida certainly would not relish the idea of Trump's return to the White House. I think China would be happier because I think Biden has been a quieter but more difficult adversary, if you will, in terms of meticulous and very surgical steps with regard to trade sanctions. So I think the idea of Trump coming back, I mean, as an American, I certainly lose sleep over that that prospect.
And could this drive sort of China, Japan and South Korea closer together if there was a Trump presidency? I mean, China would like to have a free trade agreement, wouldn't it, between the three countries?
I think it's a good point. I think it would. I think that there were, in the waning days of the Trump presidency, I think there were, signals that in some ways, China, Japan, South Korea, the one thing they agreed on was they needed to join forces in some ways against the trade wars that Trump was waging in the U.S. And I think you will see some of that. And, Trump also, he's someone who's talked before about reneging on U.S. debt, literally defaulting on U.S. debt to punish China. And, when you put someone like that back in the White House without accountability, buckle those seatbelts.
Okay, well, it's going to be a very interesting year for Japan, that's for sure. Look forward to talking to you more in 2024 about Japan. And in the meantime, have a happy new year.
You too. Same here, Peter. Thank you.
That's Tokyo-based journalist and author William Pesek.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news from across Asia to go with this show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Economist Advisory, and Louis Coyce, Chief Asia Economist at S&P Global Ratings. Also with me is Tony Nash, founder of Complete Intelligence. Please catch me tomorrow.
Money Talk